morning. I would like to call this meeting to order. Thank you for joining us during our weekly virtual breakfast MLS meeting. Happy New Year. My name is William Wei of Pinnacle Real Estate Group, and I am your January MLS program chair. I would like to take this opportunity and thank everyone for attending our breakfast meetings, and thank you for allowing me to share about myself. It has been a great learning experience. This month, Albert Chang gave us a State of the Association. Michael Brooks and Angela Lee from Directs gave us updates and insights on real estate tax withholdings for foreigners. Matt Gelfand from California for Homeownerships introduced the organization and discussed some of the state legislatures on real estate. I'd also like to thank our speakers again for delivering these wonderful messages. And we also got to know some of our affiliates a little better. So thank you, affiliates, for participating with us. Next, we have a few housekeeping tips. All participants will be muted upon entry to the MLS breakfast meeting. And should you have a question or a comment, please remember to enter it into the chat box. Please remember to join us weekly as we will have our virtual MLS breakfast meeting every Thursday at 9 a.m. As always, this meeting is being recorded and will be available online on our YouTube channel, West San Gabriel Valley Realtors. Please remember to follow WSGVR social media on Facebook, Twitter, and Instagram. You can also watch all our pre-recorded videos on YouTube. WSGVR introduced a new text message service. For updates, please text WSGVR to the number 72727. And here's a quick tip for you. The CAR Housing Affordability Fund is partnering with nonprofit organization to provide closing cost grants up to $10,000 for eligible first-time homeowners. Current counties covered for this program are Inland Empire, Riverside, and San Bernardino. In the Bay Area, there are Alameda, Contra Costa, and Sonoma, and also Los Angeles County. The HAF Closing Cost Grant Program will be launched on February 1st of 2022. Please visit https://tinyurl.com/YCXJY6Z4 for more information. Today's agenda consists of our affiliate spotlight, Carlos Rodriguez from Lewis Group of Companies, followed by our guest speakers, Chris Haun of Jam Mortgage, Judy Chow of AAA Capital Investments, and Mario Manzanilla from Rate One Financial. Just a reminder that to be eligible for today's raffle, you must be a WSGVR member and your name must be displayed to win. No telephone numbers will be accepted. Today, our affiliate spotlight will be brought to you by the Affiliate Committee, Chair Brendan Savransky and Vice Chair Joseph Nguyen. Carlos, the floor is yours.
All right, so hey, well, thank you. Good morning, everybody, for letting me be the affiliate spotlight today. My name is Carlos Rodriguez. I'm the Business Development Manager for the Lewis Group of Companies. I've been in the role for about 2 years now, and for those of you who aren't familiar with our company, we are in our 67th year of doing business as one of the leading developers in the Western states that are privately held. We focus on developing mixed-use planned communities and residential subdivisions throughout California and Nevada, as well as building and owning rental communities, shopping centers, office and industrial parks. Let me go, and I'm just going to share 3 of the bigger developments that we have in our region that are more pertinent to this group. Part of my job and what I do is to educate the real estate community on changes that are happening within real estate as we continue to develop certain areas and regions, so that as you engage the public, you're the most informed on engaging them, letting them know what's happening, what's going on. Let's see here. All right, let me tell you a little about my family. I've I've been married for 20, going on 27 years. I've got 2 kids and Daisy May, our little dog. We like to travel and get out and get crazy. This is a picture of me going through the jungle out in Costa Rica. It's my wife, Cynthia. My wife and my 2 adult kids are actually in healthcare. My wife is a nurse. My son just became a nurse a year ago. And my daughter will be a nurse. She graduates in April, and she'll be working somewhere hopefully in 2022. So we're pretty proud of them. And Daisy May, although not in healthcare, she definitely gives a lot of emotional support where needed, because it's just therapeutic just to hug that little dog. Go to the next slide. And for you that aren't aware, the Bridget Chino, we actually have a large development out there that we've worked on for a number of years, and we continue to develop. Right now, we've got 5 current builders that are selling out there. We partner with national builders. We've got TriPoint, Pulte, Lennar, Taylor Morrison. We've got 2 upcoming communities from KB and Century Homes that are coming up, one in February and the next in April, down at the Preserve at Chino. If you want more information, you can go to the website there and find out what's happening in that region. One of our communities is the resort out in Rancho Cucamonga. That's actually close to the metro station. It's between 4th and 6th Street. Over there, currently, there is only 1 developer that's still selling. There was 3. It was TriPoint, Van Dale, and New Home Company. New Home Company has got about 20-something units left before that part of that development is closed down. Right now, if you actually were to visit there, and this is actually a picture of the amenity for the residents or for the people that buy there, on the west side of the street, there's a large development. So if you're wondering what's happening there, that's going to be an apartment community called Homecoming at the Resort, and that's going to be opening in 2022. So we're excited about that. And then as you look at the entire north side, if you go and visit or look at it on an aerial, there's a large plot of land out there that is future home sites. And we don't know who the builders are yet that are going to join us, but that's going to be pretty exciting when it happens also. Next slide. Shady Trails. Shady Trails is another community out in our area. It's in North Fontana. That'd be just east of the 15, north of the 210. We currently have 4 builders out there. We've got Richmond American, Lennar, Taylor Morrison, and PLC Communities that are currently selling. That community actually first opened in about 2002, 2003, and when the downturn happened, they stopped building and the lots were just sitting there. And it was just last year that they started selling, picking up, and this is a last opportunity for people who are interested in that area to get out and own a home there. And a little bit about our community. We actually used to be known as Lewis Homes, which is everybody recognizes that. Right now, we actually broke up and we're really four businesses. We're the Lewis group of companies. And basically, the first one is apartments. We have developed 13,000 apartments. We've got 650 acres of apartment land owned and controlled, 16,250 unit development potential. So we've got plenty of development potential to help fill the gap for housing. And we currently own about 11,000 apartment units. So, and we continue to build, and that's going to keep increasing. Our second line of business is planned communities, which is what these slides were mostly about. We've actually sold 58,000 homes. We've developed a little over 24,000 lots. We've got just over 10,000 acres of residential land owned or controlled, and we've got 50,000 unit development potential. So there, we own a lot of land, and we will continue to build homes far into the future. And another aspect is retail. We've got 600 acres of retail land owned and control, 5.5 million square feet of development potential. We tend to build retail centers around our planned developments to support the population that moves into those areas, so they have places to shop, visit, and enjoy it without having to go too far out. Another aspect, office industrial. We've got 2,000 acres of office and industrial land that we control, and 13 million square feet of development potential. So these are our four main business entities that we're involved with. And lastly, if the broker community, realtors out there, or anybody wants to be informed on what updates are going on, the best way to do it is if you want to go and take your phone momentarily and register on this link, we will send you updates so that when there's a new development that's being released, some special events or anything that's going on that's related to the broker community, just remember, my job is to connect with you, the broker community, and the way that we do that the best is by being able to give you the information as it's happening right away. And that is it for me. So if you haven't got a chance to click on that, or if you need for me to send something out, please mention it in the chat window or email me, and I'd be glad to have a conversation about anything. So that is it.
Thank you, Carlos. We will now have our affiliate introductions for today. Please remember to support our affiliates with your transactions. First, we have Unita Wu of Home Warranty of America.
There we go. I finally get unmute. I'm sorry about that. Happy New Year, everyone. Unita Wu from Home Warranty of America, your 13 months home warranty. I'm here to help you anytime. I do speak English, Chinese, and Mandarin Indonesian. We're here to help. Thank you again. Happy New Year.
Thank you. And we have Judy Chow of AAA Capital Investments.
Good morning. I'm the Senior Loan Officer at AAA, and I speak Chinese and English and here to help you. Thank you.
Next, we have Sandy Franco of First American Home Warranty.
Good morning, everyone. Sandy Franco, First American Home Warranty. Have a fantastic day.
Next, we have Annie Fan from Chicago Title.
Hi, good morning. This is Annie from Chicago Title. Happy Thursday, and thank you for having me today.
Thank you. We have Brandon Savransky of First American NHT.
Good morning, everyone. I hope everyone is having a fantastic week. This is Brandon Savransky with First American NHT.
And we have John Wax of Snap NHT.
Good morning, everyone. John Wax with Snap NHD for all your NHD tax and environmental needs. 27 years of experience. Have a wonderful Lunar New Year.
And we have Nancy Chan of Lawyers Title.
Good morning, everybody. Nancy Chan, Lawyers Title. Hope that you have a wonderful caravan and 40 years in the industry. Thank you so much.
Thank you. And Cosmo Sanchez of New Aim Funding.
Good morning. I'm a mortgage lender, and I'm super excited to hear from Chris, Mario, and Judy. These are my colleagues, and they have a wealth of knowledge. Good luck, guys.
Thank you. And next we have Angie Tan from First American Title. Is Angie there?
Sorry. Hi, guys. Angie Tan. Have a wonderful caravan. Can you guys hear me? Hello?
You're a little spotty.
Okay. Sorry, guys. Can't hear you guys. Can you guys hear me?
Yes, we can hear you, Angie.
Oh, okay, there you go. Because I was like talking earlier and no one could hear me. Hi, guys. Angie Chang, First American. Have a wonderful caravan. Bye.
Thank you. And we have Mark Wu of Allstate Insurance.
Good morning, everybody. For those of you who celebrate the Chinese New Year, happy Chinese New Year. Mark Wu for your property insurance needs.
Here we have Sage Gomez of My NHD.
Good morning, everyone. Sage Gomez here with My NHD. Have a great day.
Thank you. We have Maria Howard of Old Republic Home Protection.
I'm sorry, but I believe Maria is not here.
Okay. All right. We are also happy to include open pitching to our virtual MLS Breakfast meeting. Today we have two listings, one from Rayling Wong of Populous Realty, and we also have Ashley Tan of Hanford Realty Corp. So first, I believe this is Rayling Wong.
Not sure if she's here. If you are here, Raylene, can you please
text that you're here in the chat box?
The chat box? Yeah, because I don't see. Oh, I'm sorry. Here she is. There we go.
Good morning.
Good morning.
This is Rayling. I'm pitching my listing 818 Santa Fe Avenue, number B, San Gabriel. Please come by, join us for the open house today. Thank you.
Thank you. Next, we have Ashley Tan from Hanford Realty Group Corp.
Good morning, everyone. My name is Ashley with Hanford Realty. I'd like to introduce my new listing on 6157 Reno Avenue in Temple City. This is a contemporary brand new single-story custom-built home with 4 bedrooms and 4.5 bathrooms in the award-winning Temple City School District. The home features 10-inch high ceilings. All windows are thermal break aluminum, custom-built cabinets throughout the entire home, Jenner appliances, and so much more. We will be hosting an open house this weekend on Saturday between 12:30 to 3 and Sunday between 12:30 to 3:30. So we hope to see you there.
All right, thank you, Ashley. At this time, I would like to introduce today's speakers, Chris Haun from GEM Mortgage, Judy Chow from AAA Capital Investments, and also Mario Manzanilla of Rate One Financials. The floor is yours, Joseph.
He's muted. So is Chris. Ellen, you want to unmute him?
There you go. Can everybody hear me?
Yeah, and then Chris is still muted.
We got it, Judy.
Got it, thanks.
All right. Good morning, everybody. My name is Joseph. I'll be your moderator today. I'd like to introduce Chris Haun with GEM Mortgage, Judy Chow with AAA Capital Investments, and Mario Manzanilla with Rate One Financial. And today we'll be doing conducting our 2022 lenders update and panel. If you guys have any questions, please feel free to just type it in the chat. If we have some time, we'll do our very best to get to it. Yeah, real quick, I'll be asking each individual a question one at a time. Chris, would you like to introduce yourself real quick?
Sure. So I'm Chris Haun with GEM Mortgage. I've been in the industry now for 31 years. I'm a branch manager of GEM Mortgage here in Alhambra, where I've been for, gosh, again, since about 2004. And yeah, I specialize in residential financing, anything from 1 to 4 units, purchases, refinances, do a lot of first-time buyer stuff. So if you have people that don't have a lot of money, but qualify otherwise, I can help them with that as well. And yeah, just happy to be here. Been here a long time. Most of that 31 years, a member of this board. So very excited to be here. Thank you so much.
Thank you, Chris. Judy?
Yes, this is Judy Chow, Senior Officer, Loan Officer at AA Capital. I've been in the industry over 30 years, like Chris, and I do full doc and easy doc loan. And let me help you pre-approve, take your time to funding and close. Thank you.
All right, thank you, Judy. And Mario.
Well, good morning and Happy New Year, everyone. I have been also a board member for over 25 years, been a lot of experience in lending, and graduated from Cal State University, Los Angeles in economics. I love the martial arts. And the last 5 years, I've been specializing in reverse mortgages, helping the growing demographic of seniors to financial independence. Thank you for the opportunity.
All right, thank you, Mario. So without further ado, let's get started. So I'll be asking Judy first. First question, what are the major qualifying guidelines, difference and benefits of non-QM or AKA easy qualify loans versus full documentation loans?
Okay, so I've been doing loan for over 30 years, and like Chris, we also do full doc. In the last couple of years, non-QM or the easy document has been very popular. So I'll briefly talk about what the difference is. The full doc requires 2 years of income documentation, tax return, W-2, income expense, and lease agreement for all your property. Easy Qualify does not require those. So for people who do not report enough income, non-QM or Easy Qualify loan is providing alternative way of lending. What are the advantage? Okay, it's more flexible underwriting, and some product you don't have to do the debt to income ratio. Also, we can take LLC, corporation entity, and non-wordable property when you have not enough ratio between owner and tenant in a condo. And there's no season or source of fund requirement if your loan to value is 65% or less, so you don't have to provide where the fund is coming from. And we also do foreigners loan, interest only loan. It can go up to $4 million, and 100% gifts are allowed, except for foreigners, 50%. So those are some of the key difference, Easy Qualify. Thank you.
All right, thank you, Judy. Next question is for Mario. What are the main reasons people or clients want to get a reverse mortgage?
Well, great question here. Actually, number one thing to know is that the reverse mortgage is a retirement tool. The minimum age is 62. However, now there is a new one for 55 plus. But the main reasons are they can buy a home or refinance a home with a reverse mortgage. One of the main things is eliminate the mortgage payments, meaning there will not be a mortgage payments. That's a big one here because they can use that money for their retirement instead of paying the lender. By doing so, they can stretch their retirement savings. They can preserve their investment portfolio. Also, many of them, they can delay taking Social Security for greater benefits. So it's really a lifelong growing safety net. So bottom line is, the main reason, the primary reason that I've been finding out is really a strategy and the desire for financial independence for the senior community wants.
Well, thank you, Mario. Next question is for Chris. What are the new conforming and high balance loan limits for FNMA or FHLMC Freddie Mac and FHA in 2022?
Great, thank you very much. This is the first time I've put on a tie in like 2 years, so I have a little tightness around my neck.
Looks
here.
good.
But anyway, so yes, it's been a huge increase. It's probably one of the biggest increases I've seen in a year-over-year increase to our loan limits. And I'll start with Fannie Mae and Freddie Mac. They use the same loan limits. But basically, each year they look at how much has value gone up over the past year and try and increase loan limits to accommodate that. And basically, it's been about an 18.05% increase this time. Went from $548,250 on a single unit up to now $647,200 for a single unit. 2-unit property can go to $828,700. 3 units can go to $1,106,650, and 4 units, $1,244,850. And that's just the conforming low balance limits for counties like Riverside, San Bernardino, LA County. But LA County also has a high balance limit that San Bernardino and Riverside do not have. So keep in mind, you go above that limit of $647,200 in those counties, you're going to have to get a jumbo loan. But LA County has high balance, and high balance now for a single unit, it's almost $1 million now. It's $970,800 that you can go to in a conforming Fannie Freddie high balance loan. So it's going to follow basically the same guidelines that you would have on the stuff under $647,200, other than a little bit of an increase on down payment requirement. Usually got to go to 5% down minimum for a single unit, and 2 to 4, you're going to have bigger down payment requirements. But yeah, big increase. And now, well, I guess with median homes being over 800,000 now, still we're a little below that, but very big increase. We're happy about it.
Oh, right on. Thank you, Chris.
Oh, real quick. I forgot to do FHA. FHA is a little bit different. But for LA County, same conforming limits that we have for Fannie. But San Bernardino, it's a little bit different. Their FHA max limit is 562,350, and that's San Bernardino and Riverside. 2 units, 719,900. 3 units, 870,200, and 4 units, 1,081,450,000. So a little bit lower. So keep that in mind. FHA does not go as high in some of the other non-high cost counties. Thank you.
All right. Thank you, Chris.
Yes.
Next question for Julie. What is a non-QM DSCR loan?
The non-QM DSCR loan is probably one of our most popular. 50% of our non-QM loan are DSCR. DSCR means that it's primarily based on the subject, and then you don't have to have a job to qualify. DSCR means debt service coverage ratio, and these are for investment property. We actually do 40 states now in our company. The advantage is that we can close between 8 to 15 days because there's no trip regulation on this one. So it's very fast. It can replace your bridge loan. There's no DTI, debt to income calculation, no income required on the borrower. And its advantage is also you can buy up to unlimited property using this program. We have few borrowers. One of them has 29 property using the DSCR. Another one's doing 49. Okay, so Freddie and Fannie limits you to 10, and we can do at least minimum 20% on this program, 20% down. So that's the advantage of the DSCR loan.
Thank you, Judy. Next question is for Mario. Will the lender or bank take title of my home, or if I purchase or refinance home with a reverse mortgage?
Great question. And this is one of the biggest myths out there. I hear a lot of people says, oh, once I get a reverse mortgage, the bank is going to take my home, the title, and it's absolutely not true. Basically, so like any other regular loan, when they both pass away or something, they have 3 options. They can refinance. If one of the family members wants to refinance, they can do that. When they sell the home, they pay it off. It's just that simple. And they usually stay in the home. So the lender does not want the title. They go just like the regular loans. They keep their own title, or they can go on a living trust, however the structure they have. But the answer is no. The lender does not take title of the property. They don't. It's just like any other loan. So that's a myth. For all of you, please let your borrowers know. No, they keep their home. It's just like any other loan. They live in trust, or they keep their own title. There is no issues with that. So that's the answer.
Oh, that's very good to know. Chris, what are the interest rates doing right now, and what are they projected to do over the next year?
Okay, great. Well, all of us have been a little spoiled over the last couple of years with interest rates. Unfortunately, the pandemic, well, fortunately, the only good thing I've seen come out of the pandemic is rates got super low, the lowest I've ever seen in American history, probably, and definitely in the 31 years I've been doing this. Rates dropped to below 3% at some points, and then bumped up to maybe low 3s to mid 3s. And probably about November is when we really started to see some dramatic changes. I think at that point, on November 8th, things were going smoothly till about maybe the 29th, and they dropped probably about 100 basis points during that period of time. Then through about January 3rd, they continued to be pretty steady. But around January 3rd, we had a huge start of a big drop in buying of mortgages. So rates started to go up. Around maybe about the 18th of January, they kind of hit a bottom, and now they're starting to improve again. But yesterday we had a horrible day, lost 68 basis points in one day. So the Fed spoke yesterday, and whenever they do, the world listens and things happen. And what they said yesterday is basically they're going to be aggressively reducing their purchasing of mortgage-backed securities and debt, which will further drive up interest rates. And then also signaling that beginning probably about March will be the first rate hike. And they're expected to do 3 to 4 rate hikes this year. The last time Feds did rate hikes, they raised them 9 times over a 3-year period. So we'll have to see what happens here. But the one good thing I could say that if they do that, we might see a little bit of a reprieve and a little bit of benefit from it for mortgage rates, because usually that signals to the market, hey, we see that inflation is a problem. The feds are going to try and do something to control that, and doing things like raising short-term rates, the federal funds rate will help to slow that down. So we might see that improve rates actually when it happens. But for now, we're going to see it probably getting daily a little bit worse, just depending on what's going on with the bond market, stock market, and everything else. But they're going to go up this year for sure. We're probably going to see rates hit low to mid 4s maybe at some point, but maybe towards the end of the year coming back down a little bit. So still, that's super good rates. I mean, if you look at historically over the last 30 years even, it's averaged probably between 4 to 6.5, touched 8 at some points, like in early 2000. Hopefully we don't hit inflation figures like we had in the 80s, where inflation was at 15% and rates were 18 to 20, somewhere around there. I don't think we're going to see that, but it's yet to, we don't know. We don't have that crystal ball, so we'll have to see how we come out of this thing. But they are going to go up. Still going to be good. Still in the 4s. It's tremendous rates. So still get your clients excited. Rates are low, but get out there before they go up any further. So they will be going up.
Right on, Chris. I wasn't around in the 80s, but yeah, that's good to know. And I guess we'll just have to wait.
You didn't miss anything.
Just the cool music. That's all I missed.
Yeah, exactly. Real music.
Yeah, good music. Next is for Judy. What is the 12 months bank statements loan for self-employed?
Before I go into that, I just want to tell everyone, don't worry about the rate. It's actually going back to the normal market, which is great for everyone. We have more houses to sell, okay, and more houses to buy. Okay, so the 12-month bank statements primarily for self-employed. It's a great program because you're calculating the income based on the bank statement, only the bank statement that has income. So typically, like a restaurant owner, give us 12-month bank statement shows very high cash flow, but maybe very low profit margin because they expense a lot. But we don't look at the expense, we only look at the inflow of income. And we add it all up, and then we do a minimum of 50% expense factor to qualify. So this is great for self-employed business owner. So the advantage is no tax return. And we can go up to 90% loan to value on this one. So only 10% down. So this is a great program for self-employed. Thank you.
All right. Thank you, Judy. Going over to Mario. Are reverse mortgages easier to qualify than regular loans?
Well, that's a great question. Well, you obviously heard it from my colleagues, you know, and particularly from Judy, that there's different structures, debt to income ratios, credit, and what have you. Reverse mortgages are based on age and equity. That's about it, really. The older you are, the more money you get. The minimum age is 62. So if you're 74 versus a 62, who's gonna get more money? The 74, right? You can buy a home. Typically, they do require a large amount of equity. In most cases, I would say somewhere at 50, 60% loan to value. So you get an idea what we're looking at, you know, because they want to make sure that that equity, because that's what they're using as their bank, right? They're using their equity as their bank. They have plenty to even after they passed away, they give them all a long comparison for over the 20-year projection, depending on their age. So it's not hidden. So they're a lot easier to qualify because they're based on age and equity. For income purposes, they only require to see Social Security, whatever benefits they have, pensions, just want to make sure that they can pay their taxes and insurance. When I mean their taxes, I mean property taxes and insurance, because that's not covered under the reverse mortgage. They will eliminate their mortgage payment, but not the taxes and insurance. Just like if you do have a household paid off, you still have to pay your property taxes. So, but they're a lot easier to qualify. That's the bottom line on that.
All right, thank you. Thank you, Mario. And Chris, what is inflation? Is inflation going up, and how does it affect interest rates?
Okay, well, you've all been hearing this term probably in the news lately about inflation. We haven't heard about it for years. But yeah, we've just hit 38-year highs on inflation. But let me give you the Investopedia definition of inflation real quick. It says, the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase in an average price level of a selected basket of goods and services in an economy over some period of time. So in essence, it means that a unit of currency, like a dollar, effectively buys less than it did in prior periods. So when inflation hits, your dollar is worth less, and it's the arch enemy of interest rates and long-term securities like bonds and treasury bills. So anytime inflation starts to kick in, we're going to see those things have to go up to make it a more attractive investment for the people who put their money into those things. The Feds like to see a target inflation rate of about 2%. And we've been around the 2 to 3% for years. I haven't seen it much higher than that in probably the last 10 years. But we just hit the highest level since 1982. The average over the last 12 months ended up being 7%, which is huge compared to 2%. And I think the core, which strips out food and food gas. That was about 5.5. So still huge. You go to the market, you see what I'm talking about when, I mean, I ordered some popcorn chicken from Kentucky Fried Chicken the other day. It used to be $3 or something. It was $7. Couldn't believe it. It's nuts. How do we read the inflation? Usually we're looking at things like the Consumer Price Index, which is a measure of average change over time in prices paid by consumers for a given basket of goods. And we also look at the Wholesale Price Index, which kind of measures and tracks changes in price before they reach the consumer. So anyway, we're at the highest we've seen in a very long time. And that's the main reason we're probably going to see the Feds taking a lot of action this year to try and get that back under control and not get out of control and higher than the 7% it's already at. But it happens when there's more money coming into the market than economic growth. We've seen a lot of money flooding into the market from things like all the government spending, all the incentives they've given, all the help, which is great. But at the same time, you put all that money out there without a growth in economy, you're going to have inflation hit. And that's what we're seeing now. So hopefully we can get that under control. Good for property value, but not for anything that you're borrowing. It's going to cost you more. So that is hitting, and it will continue to hit until we get it under control.
Yeah, and I guess until they get it under control, I got to watch my basket of goods.
Yes, that's right.
Judy, question, what are the asset depletion and ATR in full loans?
Okay, these are loans primarily based on the liquid asset of the borrower. So let's start with ATR in full. That means the ability to repay in full. So for example, your borrower they don't need a job, but they have an asset. It could be a stock, could be saving, could be retirement fund. As long as they have the asset, which for example, they have 1.2 million or 800,000, something in their account, we can use that as the purchase price or refinance amount. So they don't have the job. We just make sure they have the asset. Asset needs only to be seasoned for 2 months in their account. So for example, someone has 1.2 million. Literally, they can buy $1 million home, get a loan for, I don't know, 800 or whatever, and then have down payment and then have reserve. So this is the ATR in full. So if you have client has saving but no income, it's a very easy way to do it. Okay, the second one is called asset depletion. This one is has been done through Freddie and Fannie. The major difference is that their funds doesn't have to be seasoned for 2 years like Freddie and Fannie. The fund that you have can be seasoned only 2 months. So if they have money in their account, for example, 800,000, it just has to be seasoned for two months. And the way we do the asset depletion calculation is a lot lenient than Freddie and Fannie. So for example, we do about 84-month calculation. You have $800,000 Well, you divide it by 84. That gives you $9,523 a month income. That's how you do the income. Where Freddie is $240 a month. So the $800,000 only lends you $3,300 in income. And then Fannie is even more harsh, it's $360 a month. So that $800,000 divided by 360 a month give you $2,200. So how is that different? Well, the $9,000 qualify you for $500,000 loan, approximately. The $3,000 from Freddie only qualify you for $150,000 loan, which you can't buy much. And then Fannie is even worse. It only qualify you for $100,000 loan. You can't buy anything, hardly anything in California. So those two programs are for people who have money in their saving account. They don't have to use them, but they need them as a base. So it's for, I suppose, people who are saved for retirement, etc. Stuff.
Okay. So if you have a big savings account, you're good.
Yeah, Joseph, contact me. I find you a $5 million home. I'm sure you have 5 million sitting somewhere.
Yeah,
right?
I got like 10. I got 10 million in the savings. I'm just moving on. Mario, are there any jumbo reverse mortgages to help my high-end clients purchase or refinance their homes?
The answer is yes. I'm perhaps one of the fewer lenders out there that offer jumbo reverse mortgages up to $4 million, which is kind of interesting. They're not FHA driven. They do follow the same kind of FHA guidelines. They do not have a mortgage insurance premium like the FHA. For somebody from Arcadia that has, let's say, has a $4 million home, 74 years old, owns $1 million still, can they get a get a reverse mortgage and get that, eliminate their mortgage payments? Absolutely. You know, this is what it is about. Or they can buy a property and do upgrades or what have you, up to $4 million. So they are jumbo reverse mortgages. It's slightly different arrangement than the regular FHA, but they are out there. Probably you don't hear much about it because a lot of lenders do not offer it. They just follow. Most of them have the FHA, which that's what I would say is about 90% of the market. But don't miss those high-end clients, the ones that go beyond the FHA loan limits. So the answer is yes.
Right on. Thank you, Mario. Chris,
Yes.
Is it a good time to take out cash from your home's equity while rates are still relatively low?
Yes, I believe that truly there are still a lot of opportunity out there to borrow cheap still and be able to then either hold on to that money while you've got it or invest it. Equity in people's homes has gone up dramatically over the last 2 years, but equity has zero rate of return. So if you just let it sit in your property, it's not earning a return. Yeah, it's going to go up or down based on how you pay your loan and what the economy is doing in terms of value appreciation, but the equity itself has no rate of return. So if you're able to borrow in the 3s or even in the low 4s, and then put that into something that earns you a bigger return, you're able to do what the banks do and arbitrage your money and make money. I'm not a financial planner, so I can't give financial advice, but things like even an index fund for the S&P 500, which has averaged probably 10% over most of the last 30 to 40 years, that's a good arbitrage if you're borrowing at 3 or 4 and you have tax benefit from that. So maybe you're not even really paying that amount and then you're earning a return. So plus equity, it's only there on paper until you take it out and use it. So keep in mind that if you have $1 million valued property and it should happen to lose $100,000 in value for whatever reason, you just lost that equity. So while it's there, while money is cheap, it's still wise to probably think about getting it out before it starts to get more expensive and goes up, and then you can't arbitrage or make money from it. Or just to have it in your bank account. But even people like Warren Buffett, one of the smartest investors out there, he says that a 30-year mortgage is the best instrument in the world. Buffett understands that there's opportunity cost associated with paying cash for a home or even financing for a shorter term, because now your money's tied up in the home rather than taking that and putting it into something that can earn you a better return. So I think it's a great time still. Yeah, rates are higher than they were a year ago or 6 months ago, but they're still super good. So while we've got the low rates, if you need money, take it out and have it there ready to go.
Right on. Thank you, Chris. And real quick, I just want to say thank you to our wonderful lenders, Chris, Judy, and Mario, for your time. We'll be taking this over to Q&A. Let me see here. What do we have? I know we got quite a bit of questions that came in. So the first one I see is, so can you reverse mortgage a second or vacation home? Maybe for Mario?
Great question. I think just to kind of clarify a couple of things, Chris made a great, in his last statement. You're using your equity in a reverse mortgage, right? But the key here is equity has a 0% rate of return. And by using that, guess what you're doing? You're actually using your equity and eliminate your mortgage payments. Again, that's what's in. But to answer that, is that you cannot use reverse mortgages for I should say, you can use a line of credit for investment purposes. But to get a reverse mortgage for investors, so like if you buy for an investment property, no, it is designed for owner occupied. But you can have a line of credit along with a reverse mortgage that you can use it for investments. Pretty much what Chris Haun said. Now, one key thing about the line of credit, yes, you're using your equity, but it's you can buy it for investments. And instead of having it at 0% return. Now, the other thing about the line of credit in a reverse mortgage, which is nothing else does that. Suppose that you get $100,000 line of credit, right? With years, if you don't touch it, guess what happens after 10 years? You know how much you will have in that line of credit? It doubles, 200,000. Nothing else. Can you imagine having start a line of credit and in 10 years now doubles? Now you have 200,000 accessible for investments. So the answer, two answers here. No, it is for owner occupied, and but you can use the line of credit to buy investment properties. That kind of gives you a bigger picture of the question.
All right. Thank you, Mario. Just real quick, we're a little bit short on time. So if our lenders could just shorten your answers real quick, that'll be much appreciated. Next question is, let's see, how old, I think you probably already answered this, but how old does the homeowner have to be in order to qualify for a reverse mortgage?
Okay, the minimum age is 62 to qualify. We do have another product at 55 years old. So that's really the bottom line. I just want to keep it short. 62 is the minimum age for the FHA reverse mortgage, which is the majority. But we do have another product is a separate, which is 55. It's starting at 55 years old.
Right on. And let's see, the senior, I have another question. The seniors have no income except Social Security and previous employer's pension. How can they qualify for a new loan or refinance their existing mortgage?
If they use a reverse mortgage, that's about pretty much what they will need. They're gonna look that's exactly what happened to many seniors. They cannot qualify for regular mortgages. So they look at their Social Security income, they look at their pensions, and remember what I said at the beginning, they're just looking to make sure that they have enough money left to pay for the taxes and insurance. So is there that income minus their regular expenses, which means their credit, what it would come out on the credit report. And that's it. If it's a couple, if they have about $990 a month of income left over, they qualify, period. No debt to income ratios, nothing like that. Very
okay. And then another one, man, there's a lot of questions for reverse mortgage. What are the lending fees for a typical reverse mortgage?
Well, the lending fees are pretty much the same as everything else. The difference, the big difference here comes in with the mortgage insurance premium from FHA. You know, that's the big bulk of the expense. They're a little bit more expensive than the regular loans. That's where but they are all covered within the reverse mortgage. So it's 99% is of my clients is non out of pocket. You know, so it's all covered within that. If they have any questions, further questions, they can text me, email me, call me, whatever, and I can help them for the in answering some of these questions more in depth.
All right, thank you. Thank you, Mario. Unfortunately, this is all the time we have for our lenders. Again, thank you to the three of you guys for educating us on what's going on with all our lending questions. So without further ado, thank you for having us. I will let William take it away.
Thank you, Joseph, and thank you all to our lender panel. It's such a great informative session here, and we wish you to welcome you to come back to us again. And so on behalf of the West San Gabriel Valley Realtors, thank you again for our guest speakers, and thank you, Joseph, to be our moderator. Next, we have our attendance drawing, and if you are the winner, please type your DRE member name and email in the chat box. And we will have 3 winners of $10 Amazon e-gift card. So be ready. If you're doing something else, come back, look for your name to be called. Congratulations, Carol Huang. Carol Huang, are you here?
Don't think she's here.
I think she's here. Let's move on, please.
Okay, next.
It would be great if one out. All right. Mel Wong. Hey Mel, are you here?
Mel Wong is here.
Say something. Type your name. Mel.
Oh, you know what? Let me unmute him.
Mel, going once.
Can't unmute.
Hey, congratulations.
Finally got it. Thank you.
Mel, can you type your email in the chat box, please?
I gotta find it now. Thanks.
Congratulations, Mel. Thank you, Berlin. Let's move on to the next one.
You know, I greet you back.
Second winner is Brendan Savransky.
Brandon is
here.
Wow.
Yay, thanks guys.
Okay. Yeah, please type your email in the chat box, Brendan. All right. We have Mimi Lin. Mimi Lin, I see you. Please type in your DRE member name and email.
Okay, actually, yeah.
Mimi here.
I see her.
Mimi, come back. Mimi going once. Twice.
No.
Hello. Last call, Mimi. All right, let's move on.
All right, next.
Next.
One more time.
have Chow.
I don't believe they're here.
He's not here. I don't
No.
see. All right, last lucky winner. Dorothy 10. Dorothy.
Actually here.
Yes. Her.
I'm here.
Awesome. Please type your name and email in the chat box. Congratulations, Dorothy. All right. We will move on to our next slide. And please make sure to participate in our education classes. And here is a list of upcoming classes displayed on your screen. First, we have the 45-hour DRE license renewal continuing education happening on Friday, January 28th from 9:30 a.m. to 12:30 p.m. Cost is $85. We also have a CRMLS virtual training on searching 101. It's on Wednesday, February 2nd from 9 to 10 in the morning. It is free for all members. We also have a commercial seminar on SBA financing. It's happening on Tuesday, February 8th from 12 noon to 1 p.m. and it is also free. We also have a 45-hour DRE license renewal. Again, it's on February 11th, Friday, from 9:30 to 12:30 p.m. Cost $85. And thank you everyone for joining our meeting today. And please join next week when we welcome Ling Chow as our February monthly chair. Reminder that our MLS Breakfast meeting will remain virtual until further notice. Please support our affiliates with your transactions. I would like to call this meeting adjourned. This is a new day and go out, get them.